So I remember when I began syndicating deals, structuring deals for my investors, I was the guy who would say, oh, I'm giving my investor, 15%. That's more than what he's making in the market. Or I'm giving my investor 40% of the deal, and that's more than he'll make in the market. And I justified everything else. Me keeping 60%, me keeping 85% of the deal, because at the end of the day, I was the one that found the deal. I was the one that was going to be up at night dealing with all of compliance and dealing with the general contractor if something went wrong on this deal, or the management team. So I deserve what I kept. And then I started to examine the lives of asset managers and fund managers that were managing $1 billion in AUM. And across them all, one of the things that I observed was that they understood the principle of service. And they knew that the keys to any good and great empire that was tasked with managing money was its ability to give. And that's fundamental for me as a Christian, right? Jesus says that it is better to give than it is to receive. My favorite proverb on giving is Proverbs 11, verse 24, where it says there is one who scatters, okay, one that gives, and he grows richer. And then there is one who withholds what is justly due. He is the one that grows poor. And it made me think about the idea of just because I was able to do something did not give me the right to do it. And anytime I chose to exercise that right, I was not operating in good principle. And here's what I mean. When we do things like that, yeah, we can get away with it, but we're not operating in good principle. When I, again, as I shared with you, learned about spread yields in my time of studying for my securities license, it was something that blew my mind, because for those of you that don't know, the spread yield, it's pretty much a description of the way that government issue bonds and the way that corporations issue bonds and the margins in between. So when the yields are tighter, that means that corporations are able, or the investors don't demand much from the investors, or the corporations, they don't demand much. So there's not that much of a gap. But when there's a gap, this is an indicator that investors are demanding more, because they're associating their investment into a corporation with having higher risk to that of the U.S. government, which is deemed to be safe, which is deemed to be reliable, predictable, and a good investment. The spread yield showed me that. And you have a company like Walmart that did $600 billion, and they're still not able to do bonds at the rate that the U.S. government can, because the U.S. government has a GDP of over $20 trillion, and it has a workforce that investors can rely on. And so it attracts not only domestic investors, but international investors. And a principle to take from that is that if a company like Walmart isn't able to charge for the money it's needing to the investors at the rate that the U.S. government can, who am I to determine that I can charge, outside of being my own authority, which you could totally operate in, but it doesn't go anywhere. But who am I to charge what asset managers who have been in this space for 5, 10, 15, 20 years, who am I to charge more than what they're charging? And I think it's the right to do something, but having the wisdom to not do it. So when we're structuring deals now, I have people that come to me and they say, well, how should I structure this deal? Because I don't want you to overestimate your ability to sell yourself. We're going to always understand that most of the investors we're going to raise capital from are a lot of times boomers who associate high return with high risk. So if you come to them and you tell them what I want you to tell them on the back end, you're going to scare them. So on the front end, you offer a medial return in the same way that they're comfortable with. Hey, how would you like if I doubled? Or how would you like if we gave you, prime plus 2 of what's in the market? Investors are comfortable with that. But on the back end, right, for those of you who are doing private equity syndications where you guys are expected to have an exit, I tell you, I know this is not something that's conventional, but one of the things that I begin telling a lot of my colleagues is that we structure our deals this way. Hell, we'll do a 17% return on the front end, right? But when we perform, usually it's an overperformance, and we go back and we tell our investors, because we want them in for the long call, we'll say, hey, we overperformed on this syndication. And because we're looking to become a REIT in the future, one of the things that we wrote out in our operating agreement is that any profits over 20% would go to our unit holders or our investors. And so we give them that. And no investor is going to turn that down. That is the surest way for you to get a testimonial, for you to maybe get a reallocation, and for you to get them inviting or talking about what you've done for them to other investors. And any financial advisor will tell you that word of mouth business is the best business to have. And it also does the most in the long run, because not only does it reduce your overhead for the amount of marketing that you have to do, those clients to close are even easier.